Welcome. Hope you guys had a good weekend. And really just want to dive in. You guys saw the sale I did yesterday. It was a young 23-year-old. I'm gonna help me get the actual specs. 1 second. 23 years old, $106,000 mortgage. Originally was going in there just to do the basic mortgage protection type of deal, looking at both the basic option, which is what I call the renting option, and also doing the contrary of showing an ownership option is what I use for like the return of premiums, universal lives, anything that builds a little bit of cash value, more of a permanent style product. So usually I wanted to rehash this couple things. One, as you can see, or you probably gotten emails about it if you've been with Foresters for a while now, they increased the rate from their 4.1% now to 4.3%. Subtle adjustment, but still, anytime a company can increase the interest rate on an actual product, that means things are going well, especially given the fact that they readjusted it previously. From the last time I shot this video, it was running at like a 5.6 to a 5.8, and then they made it more into a guaranteed universal life product, not so much an indexed product. So it's very competitive to the Mutual Omaha GULE product. So it's more of a what I would call the day-to-day consumer level product is what I like to use over like a National Life, American National, Transamerica, where those are more of the traditional indexed. So maybe some of your higher net worth clients, you'd probably be dealing in those spectrums. But for my day-to-day users, the middle class America, the average person, I'm usually sticking to more of a GUL approach to make sure that they're going to have that death benefit that's going to last the whole entire time. Typically being the age 100, as in addition to building up some cash value inside of it as well to have access to. So a couple different places I use the ULs, just kind of to touch on them. It's like I said, I use it as sometimes a return on premium option, bearing that the premium might be a little bit higher than your traditional ROP, whether you like Mutual Omaha, KC Life, Americo, whatever your go-to ROP company is. The universal life might be a few dollars more expensive. On average, like when I ran the quotes yesterday, it was probably about a $20 difference, almost $25 compared to a KC Life. But what you're paying for is one, an increase of living benefits up to 95%, critical, chronic, and terminal. Plus, you have an interest rate, so that money it's not going to be as stagnant. It's going to be a little bit of growth happening to that money to keep it growing. And typically speaking, the ROP or the break-even points are still going to be within that 28 to 30-year range in most cases. But the big thing I just wanted to just rehash, because I did a video on this a while back, and since then they've changed some of the terminology or verbiage to get to the certain pieces or certain facts of how the actual product works. So if you guys are on the screen share, which I recommend definitely plugging into if you have the ability to do it, just so you can see it. I will post this to the Facebook, my YouTube channel once I get done editing it. But so they have two different ways you can get the underwriting or the illustration software. If you go down to the bottom left-hand side of the actual homepage, you'll see a couple different things. You have your illustration software links. There's the Foresight, which is the online version. They have a Playwright version, and they also have the desktop downloads. Hold on, let me mute out everyone. Okay. So you obviously can download this. If you have like a PC, Windows-based option, you can download the actual software to your desktop. If you have an iPad or any type of Android device, the online browser version works very, very well, and they got a lot of the bugs out of it. So I'm going to use that one today to kind of explain the gist of it. So if you open up that software, it's going to bring you to a nifty, let me do this out the way, bug me. There we go. So if you go to the home screen, you'll see, it'll give you a couple different options, Advantage Plus, old Advantage Plus, Smart UL 2018, which is the version for most of us to be using. There's a couple states that they have to still approve it, I'm pretty sure. So I'm not sure if California got fully approved just yet on the new product or not, as well as they have a year term option. So if you ever want to draw an illustration or show the client how the policy really looks line by line, other than getting the actual policy, illustration would be the best way to actually do that. So we're gonna hit on the 2018 Smart UL option. And like I said, I'm gonna use the case from yesterday and kind of explain some of the differences. So like I said, she was a female. Her birthday's in November, so she's gonna be 24 here shortly. If you have the date of birth, it's always best to put the date of birth in so you don't mess up their age nearest calculations. And then she was a non-smoker. So what I do, that's all the client tab. Next tab is gonna be your death benefit and funding tab. So on this page, this is where all the magic happens. So in essence, most of the time, we're not going to change too many things for example, the tax compliance. We're usually going to leave it at GPT, cash value accumulation test. It's basically another version of preventing the contract becoming a modified endowment contract, or a MEC. Essentially, in layman's terms, it prevents it becoming taxable. So it's basically a form that they have to make sure you're not funding too much money inside that product, so where it makes it a taxable event, to where any type of gains then becomes subject to tax, obviously. So I typically leave it at the GPT. Down here in your death benefit option, you have a couple different options. If you hit this type, you either specify the amount. So if I want $100,000 death benefit, maximum face amount, minimum 7-pay, guideline, commissionable target face. There's a lot of different things you can choose from. The main are going to be specify amount, and what they recently added is guideline level face, which I'll explain what guideline means in a quick second. But when I first ran the illustration yesterday, I ran it for $107,000, and before we would have to do a separate calculation to get whatever the target premium was. And when I say target, I'm not talking about commissionable target. Based on that's what the figure we get paid off of for the lump sum check. And then the excess, the difference between that and the actual premium, will be your excess commissions. But before you had to do it separately, it was a pain a couple of years ago, but they recently changed a couple of things to where if you go down to this premium column, you're able to just automatically get Smart Solve. So the commissionable target, that's what we get paid off of, and the target to 100 or age 100 pricing, they changed the name to Smart Solve. So basically, it automatically calculates what that premium should be for the policy to go from now to age to 100, which is an amazingly awesome feature. Next will be the death benefit option. Just kind of backtracking a quick second. This determines if option A means level, so it means the amount of coverage, that $107,000 is going to remain the same amount of coverage the whole entire time. Or there's option B, which is an increasing death benefit. What that means, similar to the Advantage Plus product, which we'll touch on near the end of this. Option B, it just means as that client continues to pay their premiums, it does accumulate a little bit smaller cash value, but it also increases the actual death benefit. So someone that's looking for a larger death benefit, or if they're on what I would call a tighter budget, this could be a good option if they're not really too concerned about the cash, but they're really concerned about the death benefit and having that benefit grow. And option B could make sense for them to actually do it. Most of the cases I've actually ran, they're going to be option A's, level benefits. Now I'll kind of show you why. So before we get to the actual numbers, 1035 exchanges or first year lump sums are kind of in two different columns here. What that means is, say we're doing a rollover from, say, a failing universal life product from another carrier, or it's imploding, meaning that it's going backwards. Instead of it accumulating cash, it's actually losing cash year after year. And you kind of want to stop the bleeding. You can do what we call a 1035 exchange. So what that is essentially is transferring cash value from one company to the other insurance company, and it will be a lump sum premium payment. And so in most cases, any type of 1035 exchanges is going to be in addition to the actual premium payments the client wants to pay. There is an option to use that as a first year's premium where you don't have to pay anything for the first year. You're using that cash as that payment. But typically speaking, for it to perform well, you want them to get them set up on that payment plan immediately and just use that cash value rollover, something that they didn't actually have access to previously, as a good way to kickstart the cash building features of the actual policy. Down here, disbursement information. So certain people that want to take out cash from their universal lives or take out loans or the withdrawals. This is where you can actually just illustrate that. What I personally recommend doing, any type of plans to pull out the actual money or getting into the more complex situations to where, hey, I only want to fund this for 35 years and start taking a distribution from it. I always recommend calling into the actual home office just for them to actually run it properly, so it actually illustrates well. Because dealing with this software and trying to figure out the right time frames and years. So this is example, this is number 2. That means year 2 to maturity, which that's what the M stands for, would be the amount of money being pulled out the actual policy. So I've always found it easier, which I know how to do it on my personal end, but I always recommend calling into foresters and getting them to actually do it for you, so it actually looks right and actually performs well as well. Cash surrender, we're not going to deal with this one today. And then, like I said, the rate of return, just the assumed interest rate would be a 4.3, which typically you don't want to touch any of those last 2 columns. So like I said, so if you look at this right-hand side, kind of gives you some of the key specs of the actual client. Her age, state, premium, its monthly setup, the riders are already given. And then down here kind of has the summary of values. So what that means is specify premium amount. So this is, as we said, we're running this on Smart Solve Premium. So the Smart Solve, if you were to quote this out on the normal calculator, it's going to give you that 6520 as the target to 100 or Smart Solve. And then the minimum premium, so what they guarantee, if you pay the $40 a month, which is not funding the UL properly, so I highly recommend not ever setting up UL with the minimum premium. This is for emergencies only. It's guaranteed to last a 10 to a 12-year period. So essentially, funding a UL with the minimum premium works just like a term policy. So that's why we kind of strongly recommend not funding it at this level here. And then everything else kind of gives you the guideline. Single premium, if you want to pay this thing one time, how much money it's going to take to get this thing flowing and not have to deal with it. Guideline level premium, and mind you, these are annualized numbers here as well. So $8,379 for single premium. So one-time payment of basically $8,400 would get this thing started, and then no more premiums. Guideline level premium, so it's almost $800, $700, a little bit over $700 for the whole entire year to be paid inside of that. And then you're looking at 7 pay, so if you want to pay it 7 times or 7 years, basically it would be that actual dollar amount. So the big ones, it's just a good way to check, little checks and balances to see if you typed in Smart Solve Premium and it leaves this box blank, you can see what that actual premium is without having to go to the at a glance. So kicking over to the left side will be the at a glance tab. So clicking on that is going to showcase all the different values, as well as, if you notice this little error message at the very top, premium has been reduced to guideline premium limitation starting in year 11. So keep that in mind, because that's going to be the basis of what we're really talking about throughout this conversation. It's kind of showcasing the actual differences of what that does to the actual policy compared to what we did for the actual client. So this one said 650 or 6520 is the modal premium, 107,000 life face, 24-year-old female. Minimum is a $40.95. So looking at all this, it's a bunch of numbers, but it's very easy to explain to the client if you just focus on basically 4 out of the 5 columns. So premium outlay, so this would be the annualized premium set up for the whole entire year. And cumulative premium is year after year, as that client pays that premium, this is what it adds up to be, or this is what the client has spent inside the actual policy. Accumulation value, that just shows the actual value that the policy has accumulated cash-wise, but it does not mean that's the value that she's able to touch. So any type of UL product, there's technically a surrender period. That's why you see these zeros on these first 3 years. And usually that's going to happen until these numbers become almost equal. So this one's basically, it equals out at starting in year 16, to where the accumulation is equal to the actual cash value. So basically it's due to that whole surrender period within that policy, and it's designed to show that the policy is building value the whole entire time, but The cash value is what's able to be touched. So as like any other policy that builds money or any type of cash value, there's always going to be anywhere between a 3 to a 5 year period with zero growth. So for example, these first 3 years, there's zeros. It means you can't touch any type of funds. That's totally normal. The more you increase the premium, or if you try to overfund it, this gap will shrink. And also the same token, if you did a 1035 exchange, you'll see a cash value starting on usually the first, if not the second year of that 1035 exchange, depending on the amount of coverage, the cost of insurance, a lot of different factors there. And then your last column is going to be your total death benefit. So whatever the face amount was, you're able to see all that. And as a UL works, if it works properly, which a couple things I always focus on, not so much the annualized premium, it's really the cumulative premium, the cash value, and death benefit. Those are kind of the main 3 columns I end up talking about. The one thing I do point out on the annualized premium, for example, in year 12, how we saw that the limitations, or excuse me, this is actually one earlier. Limitations of guideline premiums were put into effect on year 11. So if you notice this change from $782 a year to $555, that means that they're taking less money from her. So they're throttling how much money she's putting inside this account so it doesn't become taxable. So for the next 2 years, she's only going to pay $555 for the whole year. Year 12, she only pays $134 for the whole entire year, which in reality will be based off of her monthly premium. You're looking at 3 to 4 months. That's it. And it comes back out at level at 709 going forward. So what that really says, like I said, they're just throttling how much money goes inside the actual account. What I always try to find is what I call the break-even point. So this is the one thing I actually explain to the actual client, and it's simple. It's not a set number. It's not a set year. It's just looking at the numbers of how much money she's spent and then looking at the cash value and determining what year does she have more cash value than money spent, right? So this year, the break-even point for this particular case will be year 27. Spent $19,158. She has $19,677, and same $107,000 death benefit. So that's where she broke even. So like a ROP option, if she wanted everything back on that 27th year, she can go ahead and do it. That'll be perfectly fine. Every year beyond year 27, it will be what I call profit, where she's making money on her actual money. So for example, go down to a traditional 30-year product, she would have spent $21,286. This thing showing that she has $23,691 worth of cash available in that 30-year point. So we're up about what, $2,400, $2,300 in addition to what she's already spent. So that's really the power of that indexing and using that cash value to get the policy growing. So going down further, which I'm going to go down to these bottom years, just to show this cool little thing that ULs do. So going down to year 86, 86 years old, policy year 62. She spent $43,000, just call it $44,000, and she has $103,000 worth of cash value when she's 86. Since that cash value is almost the same amount as the actual death benefit, what this does to maintain the non-taxable features of a universal life product, the death benefit actually goes up to $108,000. So in order to compensate for that cash value going to be higher than the actual death benefit, they're going to raise that death benefit to keep it as a non-taxable option. So essentially, unlike, and this is what I actually tell clients, unlike any other policy, whether it be a term, whole life, this is the only one, if you fund it properly, which it starts with the proper funding, to where as you get older, the death benefit gets higher. So essentially, you get rewarded for the longer you actually live when you have this actual policy. And the reward it rings very, very true, minus, because granted, she is 24, so therefore the pricing is going to be amazing. But it still actually works with some of the older clients if it's funded with the right amount of premium inside of it, where you should always be able to get the break-even point as well as get the death benefit to actually grow. So the sweet spot, definitely people between ages probably 20 and 55. And Once you get above that to the 60s, 665 range, it's a little bit more difficult to get these things to fund properly without spending an exuberant amount in premium. At that point, you're really just trying to get, in most cases, if they're healthy enough to qualify, the universal life option should be a cheaper alternative to a traditional term or final expense, or traditional whole life or a final expense product. The magic number is once you get about $17,000 to $18,000 worth of whole life coverage, you can get a smart UL at their minimum $25,000 for almost the same price, if not a little bit cheaper, by a handful of dollars. So essentially, I mean, it's a huge value proposition if you can show a client, here's $18,000 for $100 a month, but if we can get you inside of this product, you can get you an additional $7,000 worth of coverage for the same exact premium. So $7,000 for the same price typically ends up being a no-brainer option. That's not even getting into the living benefits based off this actual death benefit amount itself. Because most whole life products aren't going to have the traditional living benefits. They're going to have either a terminal illness option, nursing home waiver premium, confined care type of situation, where these are going to have your traditional 3 living benefits: chronic, critical, and terminal illness. Of those ones, the most important one I think is going to be the critical. That's the heart attack, strokes, cancers, ALS, dementia, Alzheimer's. Anything like that were to happen, they allow you to have up to 95% of that death benefit. That percentage, this goes for any living benefit product on the actual market, it's determined based off of actuarial tables, life expectancy, and the severity of the actual issue. So just because they can have up to 95% does not mean they're going to get 95% of that actual death benefit. They might rule it as minor heart attack, you're eligible to have 40%. So 40% minus the cost, they might get a check for $30-some thousand. So it's understanding how that actually works, which Foresters has a great accelerated benefit sheet that kind of breaks down the different features, as well as on the back side, it gives a numerical example of how that actually looks if someone were to accelerate the actual money. But I definitely like these options better in terms of having the full living benefits like some company offer of 100%, because it still leaves a portion of that death benefit on to the actual family. So the client's not going to go around blowing the whole entire life policy. They can still use that money for whatever they so choose to, whether it's paying off medical bills, taking care of house payments, college, whatever the case of it actually is, traveling the world. I mean, they have full reign behind it, but having at least that 5% portion or a portion of it where they can't touch, it still pays out upon death. I think it makes a lot of sense in terms of leaving something to the actual family, whether it's for funeral expenses and so forth. But this one, like I said, doesn't do very terrible, but I just want to show a couple different things or a couple techniques to look at. So for example, this client, we ended up talking about, I explained her the power of overfunding a universal life product. So in order to show that, so you go back to the premium page underneath the death benefit and funding tab, and we go to specify amount. So this is where you choose the exact dollar amount you want to spend inside that actual policy. So for example, we came to the common ground of, after uncovering that she had a couple bills that she's recently paid off, she freed up about $200 worth of cash on a monthly basis. Instead of being greedy and jumping on the full $200 a month, we cut it right in half. To where $100, something that's comfortable, something that she can build upon, not going to break the bank, not going to strap her too much down in terms of budgeting. We're going to use some of that money to help overfund this policy because she saw the value of it. She saw the growth potential and having another bucket of money that she can fall back on for retirement, or just like a savings account that's on steroids. While most savings accounts get 0.0% interest, this is guaranteed as a 2% return, guaranteed with a 4.3% current market rate. But so if you try to overfund this thing, we'll go specify amount, do $100 a month, and go to the at a glance. So very similar to the first one we did, where it reduced the premium. We have a little error message at the very top, or at least a notification saying what's happening inside the policy before you scroll down. Premium has been reduced in year 7 per the guideline limitations. So scrolling down, so we see a couple different things to notice. First thing I personally noticed, the cash value. So previously, this one was showing 3 years of 0 cash value. With the added premium, of course, we're going to show a big kickstart in the actual accumulation funds of the actual policy, where before that third year it was only $55 worth of cash. Now we're all the way up to $719, then crossing over that $1,000 mark into that fourth year, which took the previous policy about 6 years to actually do. Next thing that stands out to me is all of these zeros. So zeros, where the premium goes down $21 in year 7, and then from basically 8, 9, 10, and 11 it'd be 0 premium. So they're basically not going to collect a single dime for her for almost 4 years. And then again, in year 12, it's a small 134 premium. And then every year after, it goes back to the 7,009. So essentially, we broke even last time. It was on the 27th year, just a little bit over 19,000. In this option, we're breaking even barely in 23. We're about $8 short. But year 24, $17,029 spent. We have $17,495 worth of cash value. So even though we didn't pay premiums for that 4-year period, we're still breaking even 3 years sooner. But that's not the reason we're talking about it. We're kind of showing this one as the reason of what not to do. The way these universal lives work, it doesn't perform well if we're not continually funding the policy. We're not taking advantage of that compound growth that's actually happening. So they have a special feature designed to actually fix that. So despite this thing looking really, really good, and if you go down to, I think it was 86 in that range, year 62, yeah, where we got 43,000, we have almost 114 cash, our death benefit starts going up. It looks awesome and it gives the client a break, but it's not as good as the policy should be. Because more times than none, you want to overfund the policy in the early years as much as possible, because that's going to be the working years. That's when the client's actually working, a consistent income's coming in. They're not on their retirement stage where they're on a fixed budget and so forth. So you want to be able to fund this policy the best as possible in those early years and take advantage of the compound interest. So there's a cool little feature to do where we're going to change this top option. Instead of the death benefit specifying that actual amount, because what's happening, since if we have too much cash inside the policy and not enough death benefit, that's why they're not collecting premiums. So there's actually a little way. If you go down to guideline level face, what that does, it takes the actual amount of coverage out of the actual equation and determines, based off of the premium that we specify, how much coverage it's going to be to keep the policy guideline, which means is it will keep a constant amount of premium going inside the actual account. So you have the constant growth and constant accumulation happening. And come to behold, which is what we actually did yesterday, for $100 a month, they actually changed her face amount. As you notice, there's no error messages at the very top anymore. They changed her face amount to $201,000. So based off of that $100 a month premium, now the minimum premium still $65.80 now. So it's basically the minimum premium is 40 cents or 60 cents more than what her target premium was on 107,000. But she wants to pay $100 a month. So what we do is, okay, let's give her some more death benefit, essentially. $100 a month. As you notice, that $100 a month, it keeps going into there the whole entire time. It doesn't change. Now, near the tail end, we can definitely adjust it and start taking some distributions or leveling out the actual premium itself to get it to last. But the whole purpose of this is basically it's what some other companies would call minimum death benefit, max cash value accumulation. So Forrester calls it guideline level face. It's a way to basically work smart ULs or any type of universal life products backwards. So on the baseline of actually selling these, getting these things structured, is you definitely want to focus on the actual premium amount. It's come to a number, what's comfortable, what do the clients want to put inside this policy on a monthly basis, and use that to determine the actual face amount of coverage. So it's a little bit different from how we usually sell certain products where we're basing all of the face amount or going down slightly to cover a portion of the actual mortgage. This one's a different type of concept where we're really going to focus in on actual premium. It's how much premium can we actually get on a consistent basis that the client's comfortable with, and then how can we get it inside of a policy where it's going to be constantly funded to take advantage of that compound growth. So looking at this one, big difference here. So you see now has 4 years of no cash value we're able to touch. It's totally fine because we have a higher death benefit. And then going down, we're going to go back to our break-even point. So this break-even point, we're looking at year 24. So we're still about the same pace as previous. Spent $28,800. We have $29,409 worth of cash value, just when she's 48. So it's a pretty good 100% ROP in about 25 years. So a couple things to talk about with this. If you're overfunding a policy of this nature, not only do you have a $201,000 death benefit, which is more than enough to take care of their house, as well as leave them a little bit extra on for a spouse, kids, income replacement. We also, a lot of people use universal life products to pay off the mortgage early. So if you use the pitch of how we explain it to people, if you pay the extra, divide their house payment by 12, the extra 1 month or 1 month worth of premiums over a course, or mortgage payments over the course of a whole entire year, knocks off anywhere between 7.5 to 10 years off the mortgage time frame. So you're just speeding up that amortization cycle of the actual home loan. So the same thing can be done if you overfund a policy, especially with the interest rates now being a little bit closer to what the actual mortgage rates are. Once if you're pairing up that same concept, which in her case was extra $70 a month towards her principal of her house payments, and you put $100 a month inside this universal life. So essentially we are using that $200 extra cash that she has, but we're only putting 100 of it inside of the actual insurance product, leaving the other $70 out of that remaining $100 up to her to put towards her house payment. But a lot of people do in these looking at from the 20th year down to the 23rd, even to that 24th year, it's if she's really close to getting her house paid off, we can liquefy this whole entire amount of cash and make a lump sum payment to the mortgage company and get the mortgage taken care of. So a lot of people see value, especially if they're younger, getting a house paid off sooner rather than later. The longer you pay on the mortgage, the more interest you pay, the more money the banks end up making. So anything we can do in terms of tips or tricks to add value to our presentations, that's the one little golden nugget I always share with every single client. And about 70 to 80% of them have no idea how that actually works in terms of paying off their house early. Or the bank might explain the biweekly option. They didn't really dig into it to fully explain it. But doing something along these lines, like I said, you're able to cash that policy out, get either, if you wait till the full 24th year, get $30,000 out of it, and then you want to take 20 to pay off the mortgage and hold on to your other 10, you have total options to actually do that. Or even doing it a little bit sooner, depending on how fast that mortgage balance is going down. But doing it this way, I mean, you start seeing the growth take off exponentially. And if you go down, the magic year has been 86. So this case, we spent $74,400. So it's up about 15, 17,000, but our cash value is nearly almost 3 times the amount of money we actually spent. And not very soon after, where we only spent $76,000, or excuse me, $75,000 in year 63, 1 year later, and we have 194 grand worth of cash, her death benefit starts going up to 204,000. So essentially, she's only spent $75,000, and if she passed away, she's going to get a $204,000 payout still. Or if she wants to take her 194 grand worth of cash tax-free, she has that option as well, with either a loan or the withdrawal option out of the policy itself. As long as there's a death benefit maintained, like I said, this can't be taxable in terms of cash value. You're just using your own cash, and then you have that remaining death benefit. If she took out a loan, for example, and she took out $50,000, it obviously would subtract for the death benefit if she did pass away. But it just shows the power of, if you fund a UL properly and do it the right way, I mean, the growth can be crazy, as well as the death benefit can start overfunding itself and growing as well with the actual client based off their actual cash value. So it's just the one little trick. Like I said, it's instead of trying to do an overfunded UL, which I used to do previously and take those 0 years, if you just make one little switch, and instead of looking at specify amount or face amount, and look at the guideline level face and strictly base it off of how much premium the client can actually afford on a monthly basis, the growth is going to turn out 10 times better than what it previously did, simply because there's no lapses in the actual payment. There's not going to be that 4 or 5 year law where they're not collecting any type of premiums, and you're missing out on that compound growth due to the interest rate and the cash value that's already been there. So with that, because this actually took a little bit longer than I thought, I'm going to open up for some questions. I'm going to unmute everyone. If you have a question, unmute yourself and ask away. So you guys should all be unmuted right now. Are there any questions, comments?
Yeah, I'll go first. Are you there? Can you hear me?
Go ahead, John.
That was really, really well done. But, you know, not being familiar with all of this, of course, that went over my head. So I was listening. Very, very interesting. What are you going to do? Post this? Have it available on your YouTube?
Yeah, I'll put it on the YouTube channel. Now, this is just something just to explain to you as agents, so you kind of know how to at least do a basic illustration. Anything that goes over your actual head, don't be afraid to call into the Forrester's sales and marketing team. They're awesome. And they'll be able to run these to you and get them emailed to you extremely fast, or even calling me and we can walk through a couple. Because usually, I mean, I'll walk through the first couple just to kind of get the gist of it. But just being able to show this versus having to print out 3 different options of actually doing it, it's a little bit easier. Because literally, I mean, we spent, once you understood the concept, we spent probably about 25 minutes just talking through all the different situations. So instead of me having to print out 3 different options or come back a different day, we did all of that on the actual spot. And mind you, it was a Sunday, so therefore the home office isn't open, so I can't call Forresters to actually do it. So I really didn't have a choice and wasn't going to come back later. And because she was bought into it once I explained the differences between a basic term, which I call renting, the ROP option, which is what I use like KC Life for, and then showing how this one is a little bit more expensive option, which I always tell people this is the more expensive, or if you want to use a good analogy, you got the Honda Civic as your basic term policy, you got the Lexus as the ROP, and this is going to be the Cadillac or the Mercedes-Benz of all the products, to where this is the top of the actual line. It's going to be a little bit more expensive, but the value that you're getting out of the product, it makes sense. There's a lot more value proposition inside that UL. And unbeknownst to me and to my actual surprise of the whole matter, I mean, usually in that situation in which I don't stereotype clients, I just have a good read for them. I thought it was just going to be the $35 a month KC Life ROP for $107,000. She gets back about 12 grand at the 30-year point. Then she kind of started talking about, because when clients get something or they see value in something, they start telling you about their whole financial outlook. I mean, she was literally telling me where she found money to actually afford this. And we contemplated we looked at 100. We also went up to about 200 bucks a month, which the face amount went all the way up to 400,000. Mind you, this is a lead she's 24, $107,000 mortgage. If you know the Columbus area, it's a starter home. I mean, it's not the nicest neighborhood. She made 2,500 bucks a month. I mean, it would not be the typical client that would usually go for this. So it was very surprising to me, but only thing I did special was I put all the options out there. So that's one thing I definitely recommend doing, and I try to push all the agents to actually do, is you can't sell what you don't show. So if you don't show the high premiums, you'll never sell the high premium case. Because if the client can't afford it, like I said, we have the Lexus option or we have the Honda Civic option. What option appeases you for your situation, they're all going to get the same job done. In terms of, if you died, loan gets paid for. It just depends on, do you want the extra features, or do you want to invest inside of you in the chance of you actually living and turning your money into something else? So
one other thing real quick. But when you went to the first page on this, you said, so instead of doing what I used to do, blah, 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 I went to the guideline level face. What was that first thing that you showed?
Yeah, so before, I would keep the same specified amount. So for example, it was 107,000. And if clients, they want to overfund it to, hey, I can spend XYZ dollars amount on a monthly basis, I would pop that into the premium amount under specify premium. I put $100. In doing that, what happens, this little message pops up. Premium has been reduced to the guideline limitation starting in year 7. So what that means, they're not going to take any premiums these 4 years from her. And if you notice the cash value, there's no more premiums going in. It's a little bit of growth due to the interest rate, but the cash going from year 7 to year 11, it goes from 135 to 500 466. While these other previous years, when there's premiums, you're seeing $800,000, $900,000 jumps worth of cash. Well, this one only gets barely $400 grown because there's no money going inside the actual policy, and then it tapers off to a smaller amount, the 09. So what that box does is basically, this is telling me, hey, we like the premium, we only can take it for so long because of the death benefit. The death benefit isn't big enough to maintain that higher premium. So they have an option exactly for that situation where you don't really care about the death benefit. It's all about the cash accumulation. So that's what we call the guideline level face amount.
And what was the first one called rather than the guideline?
Specify amount. So you
specify amount. Okay. All right.
Type in the exact amount.
Okay.
So that's what that does. It basically says, hey, the death benefit, we'll calculate that for you. Basically, letting the software do all the work and guesswork for you, and we'll show you how you can fund $100 a month constantly the whole entire time and see the growth that's going to come out of it.
Right.
So that's why you see this. Now, granted, it's a different ball game here in terms of the first couple of years of being able to touch it, but I make that known. Most policies that build cash, you can't touch it for the first three to 5 years.
Exactly right.
Totally normal. But comparing this one to the other one, yeah, we might have spent $13,200 compared to $8,000, but the cash value is at $7,410 compared to $5,466.
Okay, one last question, then I'm going to get off so other people can talk. So you used to do it the other way first, and obviously this does appear to be better, even though it costs a little bit more.
Yeah. So
how did you discover this over the other all of a sudden after doing the other for a while?
When they changed the product. So when they redid the product, they changed some of the terminology inside of it. So how it's actually structured. Because before it used to be, like I said, it was really a mundane. There wasn't as many options inside the premium side. So the smart solve wasn't there. Conditional target wasn't there. You would kind of have to do the guesswork of where the whole adage of whatever the target premium was, add $7 to $15 to it for it to overfund. That was kind of the formula that worked almost every single time just to get it to be overfunded. And then they redid it to where it's more of a traditional setup now, where a lot of other illustrations companies are doing either guideline level faces. For example, National Life calls it max cash value, minimum death benefit. That's what the option's actually called. So it's learning all the different little quirks that each company has, but this is kind of the day-to-day product. I just want to at least touch on this one and kind of revamp the original video I did on the Smart UL product to kind of go over basically how to actually use it now, what's changed and how to actually get the most out of the product, and basically how Universal Life's work. It's they will throttle the cash if there's not a death benefit. So that's literally how I designed my own personal product, where, like I said, it's a National Life product, Flex Life 2. It's at $368 in terms of death benefit with $250 accidental death. But I set it up as it spit out the random numbers to me because I wanted to spend $250 a month on it. So, and then it just gave me the actual answer of, hey, here's how much premium you have to have. So that same thing would happen if you kept the guideline level face and you went to riders. So this is where you can kind of pick and choose the different add-ons. If we added the accidental death rider onto this policy, which we're going to actually choose, we'll leave it 300. It's fine. You can change this amount here. But if you notice on this side, on the right-hand side, the base face amount coverage dropped down to 171. So basically, it automatically calibrates everything to where, so get guideline premiums limitations starting in year 47, which if I had to guess what year 47 was, that's when she turns right after her 70th birthday. So this one only has the error message because the accidental death rider is going to fall off at age 70. So that's where the premium is going to go down by the $155 difference, just because that's how much the accidental death rider cost. So if you go up here, if you multiply out that 1461 accidental death rider cost times 12, That's, oh, it's 175, 32. So it's about, is my math wrong? I must have said that wrong. Yeah, it's close. There's probably some policy fee built in there somewhere. So, but either way, this is where it drops off in terms of paying $1,200 a month compared to paying $1,045 a month. But the same growth, it pretty much does the same exact thing. You're a little bit slower growth rate in terms of the accidental death rider was there. So any type of death by accident, this thing would have paid out $471,000. So it uses the same cost adage. If I want to spend $100, it'll move the premiums around to make it work. But it's definitely not going to grow as much. So if you had accidental death rider, you might want to, instead of doing $100 a month, you might want to account for that $10 difference or $14 difference. So if I run this at $115 a month, it'll probably look normal, I have to guess.
Very interesting. Thank you. All right.
Yeah, so yes, this thing looks 10 times better because it's more than double now. So it's kind of right back on track to where we were to start, is to add in the accidental death rider. So our death benefit goes up $30,000 by adding just $15 a month. So we're kind of back into that 201. It was technically $332. This one's $200 short. So sometimes you want to add the accidental death rider, just if you want to account for that inside the premiums. They'll keep the growth rate the same. You're not really gonna have that drop off where it looks really weird. But yeah, I mean, it's a very strong product. Once you kind of understand how to use it, it's a good question though. Anyone else have questions? Anything on your end, Ray, Dustin, or Rick?
Sounds good, Marcus.
Right on. Appreciate it. Nothing from you, Rick? You always have a question or two for me. All right. Well, yeah. No, thanks you guys for hopping on. Appreciate it. And like I said, I always definitely get this thing posted to YouTube channel and probably sometime throughout the week. Just once I get it edited and make it look pretty. But then probably the following week we'll dig into the Advantage Plus product, which is participating whole life. So main difference, kind of give you a quick snapshot. I mean, we're looking at different interest rates. Cost of insurance stays the same on the whole life product versus this cost of insurance goes up, but the interest rate, while it's funded properly, counteracts that. But no, it's a really strong product. Definitely a lot of people use it for the MP world in terms of giving that term and perm setup to where you get a small portion of permanent coverage and you pair it with a 20-year term or a 10-year term. I'll kind of go into how that works and different features and advantages of that whole thing. But until then, thanks guys for hopping on. We'll catch you guys next week.
Bye.